Hello, good morning. I wish that I could see all of you in person, but we're really glad that you could join us for this virtual session today. I think I stole that line from every other person who has been doing a virtual training this past 8 months, and it's getting a little bit old. But, I do get to wear my running shoes while we talk to you guys today. And that would have been frowned upon if we were live in person. So, there's an upside to this. Anyway, we really appreciate you giving us some time this morning. I'm Anna Steppen. Joining me are Blaine Martin and Albert Flores. We're all part of the tax team here at Maxwell Locke Ritter. We also have our awesome marketing director, Stacy Sprayberry. She's running things in the background. So if you have any technical issues, you can chat her on the side and let her know. She'll try to help you out. So there's a lot going on in the tax world, a lot we're trying to keep up with. Our goal today was to talk through the issues that we think are probably most relevant for our clients and for the Austin business community. So we've got limited time. We're not able to cover every single tax issue or every question you might have. Notably absent are estate planning issues and international tax issues. We kind of figured those had a little bit more limited applicability. That said, if those are of interest to you, we or our colleagues would love to talk to you. So please do get in touch and we can talk about those things. A couple of housekeeping items. We do plan to pause for questions a couple times throughout the session, and then we will have a longer Q&A session at the end as well. So please use the Q&A function as opposed to the chat to put questions in, and we'll answer them live, or we may send some follow-up emails if we can't get to everything. There's also, this is CPE, so there's going to be a polling question, just one, so it's easy. So please do answer that when it comes up. And with that, I'm going to hand off to Albert, and he's going to get us started on some of the CARES Act provisions.
Thanks, Anna, and good morning to everyone. So we will first discuss the tax law changes related to the Coronavirus Aid, Relief, and Economic Security Act, otherwise known as the CARES Act, which was signed into law in March 2020 and also included several non-tax related relief funding for the COVID-19 pandemic. So in the next slides, we'll talk about net operating losses, business interest expense, excess business losses, qualified improvement property, charitable contributions, retirement distributions, and employee retention credit. So the next slide, we'll talk about net operating losses first. So just for background, the Tax Cuts and Jobs Act, which I'm going to name the TCJA as I go forward. The TCJA made changes to the NOLs that were generated after December 31st, 2017. So this included making the NOLs a indefinite carry forward period. The utilization of these NOLs were limited to 80% of taxable income, and it also eliminated the 2-year carryback period. The CARES Act made several changes to the NOLs from the TCJA, including temporarily removing that 80% of taxable income limitation for tax years beginning before January 1st, 2021. It also provides a 5-year carryback for NOLs arising in tax years beginning in 18, 19, or 2020. A few things to know on the 5-year carryback rule, that the NOL carryback rules also apply to individuals, estate and trust, and tax-exempt organizations. Election can be made to waive the carryback period. The carryback will not affect any Section 965 transition tax that some taxpayers might have been subject to back in 2017. And there are special rules for life insurance companies and real estate investment trusts. So what does this all mean to you? So these changes allow a few opportunities for taxpayers that generate NOLs in 18 or 19 and who are expecting maybe an NOL in 2020. The temporary repeal of the 80% limitation kind of combined with that new 5-year NOL carryback rule, affords taxpayers the ability to utilize NOLs in taxable years beginning as early as 2013, and 2, to offset taxable income in those prior years that have been subject to tax at a higher rate. Overall, these changes are intended to allow taxpayers to utilize NOLs and amend prior year tax returns, which will provide additional cash flow. It might be worth to look at planning opportunities to accelerate deductions or defer income for 2020 to create an NOL that can be carried back. For example, perhaps it's worth a discussion with us to look at accounting methods to accelerate any deductions such as prepaid expenses. And in addition, before claiming an NOL carryback for a prior year, taxpayers might want to consider how other tax attributes, such as foreign tax credits or R&D credits, how they were absorbed in a prior year and how they may not change because of a carryback. Other considerations include the impact of the taxpayer's alternative minimum tax liability, if any, in the carryback period. As you see on the slides right now, we created a slide to kind of put together a summary of the net operating losses. As you can see, for any NOLs that were generated before 2017, that NOL has a carryback period of 2 years with a carry forward period of 20 years, and it could offset taxable income by 100%. For the NOLs that were generated before December 31st, 2017, and before January 1st, 2021, they're subject to a 5-year carryback period with an indefinite period for carry forward. And this is where it gets tricky. So these NOLs, they can offset taxable income 100% through 2020, but after 2020, they can only offset taxable income by 80%. And then for any NOLs generated after January 1st, 2021, there's no carryback eligibility. It has an indefinite period of carry forward, and it can offset taxable income by 8%. So on the next slide, many clients have asked us how NOLs will be treated post 2020. So as we just spoke about, the CARES Act reinstated the 80% limitation with 2 changes. First, the CARES Act provided that the limitation is to be calculated based on 80% of taxable income after the utilization of pre-2018 NOLs. Also, the 80% limitation is determined before the deductions for qualified business income, foreign derived intangible income, and global intangible low tax income. So we have a quick example here just to kind of show how that calculation will work. Say if taxpayer has a taxable income of $200 in 2021, say taxpayer also has pre-2018 NOLs of $120 and 2019 NOLs of $100. Thus, that 2019 NOL will be limited to $64. And how we got that was to take the taxable income of $200, subtract the full pre-2018 NOLs of 120, and multiply that by 80%. And then thus the taxable income will be $16 for 2021. So that's enough about NOLs. We're going to move on now to business interest expense. So again, just for background, the TCJA back in 2017 kind of changed the business interest expense limitation to the sum of the taxpayer's business interest income, 30% of the taxpayer's adjustable taxable income, which is sort of an EBITDA calculation, and the taxpayer's floor plan financing interest expense for a taxable year. The CARES Act made several changes to the interest expense limitation, including changing that threshold from 30% to 50%. For tax years beginning in 2019 and 2020. However, you may still elect to apply the 30% adjustable taxable income limitation going forward. You also may elect to use your 2019 adjusted taxable income in computing the 2020 limitation amount. And also there are special rules if you are partnerships or if you have short taxable years in 19 and 2020. So really the takeaway of this slide would be, the increased deduction and election will benefit taxpayers that have a significant decline in 2020, enabling taxpayers to increase their ability to deduct interest expense. And to the extent that NOL arises in 19 and 20, based on the increased deduction and election for interest expense, that NOL is now available for carryback. So next we'll talk about excess business losses. Again, what is excess business loss limitation? So for background, as part of the 2017 TCJA, Congress did amend Section 461, which eliminated the ability of individuals, trusts, and estates to deduct trade or business losses greater than $250,000 in any tax year that begins after December 31st, 2017. For married individuals filing jointly, that limitation was doubled to $500,000. What the CARES Act did is the CARES Act amended the TCJA such that the limitation on excess business losses is now postponed until January the 1st, 2021. As a result, affected taxpayers may be able to fully deduct business losses arising in 18, 19, 2020. Starting in 2021, taxpayers also may treat these losses as net operating losses. In addition, the CARES Act made a few changes to the TCJA with respect to how the calculation of excess business losses will be done. So for example, starting in 2021, excess business loss will be determined without including net operating losses, without including qualified business income deductions, and without including deductions, gross income, or gains attributable to performing services as an employee. So really the takeaway from this slide would be, to the extent that an 18 or 19 federal income tax return has been filed and it did report an excess business loss, a taxpayer, which would be an individual, trust, or estate, will need to evaluate amending the return to claim a refund of taxes or to report a net operating loss. And now I'll turn over to Blaine to chat about QIP.
Thanks, Albert, and good morning to everyone out there in their virtual settings. So the CARES Act also included another technical correction to the TCJA in regards to qualified improvement property, also known as QIP or QIP. So originally in the TCJA, they omitted QIP property from the 15-year class life definition, which defaulted it to the 39-year class life. And this resulted in two kind of bad results for the taxpayer. One, it expanded the recovery time from 15 years to 39 years, and it also made QIP property ineligible for bonus depreciation, also known as 100% expensing. So it kind of hurt real estate people who have qualified improvement property or tenant improvements or things like that. And you can see on the slide the definition of what qualified improvement property is. So through the CARES Act, they retroactively changed this to include QIP in the 15-year class life. And they also provided two remedies for taxpayers to kind of take advantage of this missed depreciation if they had already filed their 2018 or 2019 returns. So the first option was to go back and amend those returns and take the deductions in the current year and so on and so forth. This is a little cumbersome, especially for partnerships, because that would require not only for the partnership to amend their return, but also the partners would have to go back and amend their individual returns as well. So the second remedy, which is a little easier, still some paperwork involved, is filing the 3115 accounting methods change, which would allow a taxpayer to just recoup all of that depreciation that was missed in either 18 or 19 and take it all in the tax year that they're filing the 3115. So just getting it all through, kind of limiting amended returns and things of that. Those are the two remedies and fix that were in the CARES Act related to QIP. So now I'll turn it back to Albert, who's going to talk a little bit about the CARES Act and how different states conform to it.
Thanks, Blaine. So we do have a slide on state conformity, or maybe I should say the lack of state conformity. So net operating losses, after we discussed, for carry back and carry forward rules, majority of the states have their own NOL provisions. Only a few states will conform with the actual federal rules. For business interest limitations, there are around 20 states that would automatically conform with the federal rules. However, the rest of the states vary greatly on conformity with the Section 160J rules. For qualified improvement property, overall for depreciation, most states do not conform to the federal bonus depreciation rules. For QIP, states conform on either a fixed date or rolling basis. So states with a rolling conformity would automatically pick up the QIP change. States with fixed date conformity will not immediately pick up the QIP change. So really the takeaway is that taxpayers should pay close attention to the CARES Act conformity guidance published by the different state jurisdictions. States usually fall in one of four categories. They are a rolling federal conformity. There's no conformity to the TCJA or the CARES Act. They could conform to the TCJA but decouple from the CARES Act, or they can just march to their own drum, right, and have separate state provisions. So overall, just need to think about the states that you operate in and how the state rules will differ from the federal rules. So back to Blaine now on charitable contributions.
Okay, so through the CARES Act, they made some provisions to kind of incentivize taxpayers to be a little more charitable in this kind of rough and tumultuous year where people are kind of needing more help. So the first of those changes was for non-itemizing taxpayers. So that's people who normally would take a standard deduction. Through the CARES Act now, those taxpayers are afforded an above-the-line deduction of $300 for single taxpayers and $600 for married filing jointly taxpayers. And so essentially said another way, they will get their standard deduction as well as a little bit of charitable contribution deduction up to those limits. Any amounts made over those limits, if they're not itemizing, unfortunately do not carry forward. They're kind of lost. But they do have that ability, and this would become effective on the 2020 return and kind of going forward until it sunsets. The other provision is for itemizing taxpayers, and so it expanded the limit of charitable contribution deduction from 60% to 100%. So before the CARES Act, no matter how much money you gave, you could only deduct 60% of your AGI, or we'll call your income for the year. Through the CARES Act now, you could give away all of the income you made in that year and get a full deduction for it. Unlike with the 60% limitation, anything above the 60% would carry forward to a future year. There is a little bit of fine print with this change. One, it has to be made in cash and to a public charity. You can't put it to a donor advised fund or a vehicle that would then give the money out later. Because the real intent of the bill was to help people in the here and now and not necessarily in the future. Also, donations to private foundations are still limited to 30% of AGI. So that, again, is kind of the same vein of wanting funds to go to people now and not necessarily vehicles that would make the donations in a future date. And then the third piece is this limitation expansion is just for 2020, not future years. So it's really advantageous to see if you can bunch your charitable contributions this year, which we'll kind of talk about later on. Similarly, real quick, sorry, Stacy. Similarly, there's a limit on corporations that was previously 10%. This expanded to 25%. And so on the slides that went out yesterday, your PDF slides, it might show 100%. That's an error. We apologize for that mistake. We got a little ahead of ourselves in making our own tax policy. But the 100% limitation is, again, just for individual taxpayers. The corporate expanded limit went from 10 to 25. So that is kind of the CARES Act's remedies to get people to give money away. In terms of retirement plans, the CARES Act had two changes that were kind of on opposite ends of the spectrum. So the first one was they allow certain taxpayers to take out $100,000, up to $100,000 from a qualified retirement plan, whether that's an IRA or a 401k, and waive the early distribution penalty, which is usually 10%. You can see on the slide here, there's about 4 criteria that a person would have to meet to be eligible for this early distribution, all related to COVID. You have COVID, a spouse, a dependent, lost your job because of COVID, couldn't work, financial stress because of COVID. And they left these definitions sort of vague, I think, intentionally in order to make sure if someone needed the money that they could get it out early and not have to pay that early distribution penalty. In addition to waiving the penalty, the CARES Act allowed for these taxpayers to spread the tax on that early distribution over 3 years. So they could pay 1/3 in 2020, they pay the next third in 2021, and then the final third in 2022. This is just an option. If the taxpayer wants to go ahead and pay the full tax in the year of distribution, they can do that. No harm, no foul. It's just an option to kind of defer that tax. Also, if the taxpayer over the next 3 years decides they want to pay that money back, they can do so and then go back and amend those returns that showed the early distribution and recoup and get the taxes paid on that early distribution refunded to them. So basically, this is kind of a cash flow mechanism through the CARES Act to get people cash that needed it in the short term, and if they wanted to give it back, they could. If not, that gives them an opportunity to spread the tax and kind of avoid the early distribution penalty. On the other end of the spectrum, the CARES Act suspended required minimum distributions for 2020. So usually taxpayers that are 70 and a half and have an IRA or 401k are required to take out a calculated amount. Also, taxpayers that maybe have an inherited IRA have these required minimum distribution rules. Those were all suspended this year, and I think the purpose behind that was not making people kind of incur an undue tax liability based on these required distributions. Then kind of finally, in terms of tax changes with the CARES Act, there was the creation of this employment tax credit or employee retention credit. And we can go forward one more slide, Stacy. Thank you. So very high level on this. This is a payroll tax credit that employers, certain employers, they'd have to meet certain economic revenue thresholds that's kind of comparing a prior year to the current year, that would allow them a 50% credit on wages paid to employees during this hard time. Overall, we very much point you to your payroll provider on this subject. They're going to be way more well-versed in the rules and how to calculate who qualifies and how to actually get that credit refunded to you. We just kind of wanted to bring this to everyone's attention to let you know that it's available and to kind of seek guidance from your payroll provider in terms of calculating it. So with that, I will turn it over to Anna, who is going to discuss the big ticket item, which is PPPs.
Thanks, Blaine. So Blaine and Albert talked about some of the tax provisions that were in the CARES Act, the main ones, and those were all kind of helping reduce your tax liability, get you more cash as soon as possible based on tax law. But another big part of the CARES Act, of course, was this Paycheck Protection Program. And the SBA loans under this program have been extremely popular. It was really a key way for the government to inject some liquidity into the economy in this rough year. So the deadline for applying for these was August 8th. There's always the possibility that there could be more funding for this on the table if we get another COVID relief bill. But as of right now, if this is relevant to you, you already got your loan. So we're not going to kind of belabor the basics of the loan today. Just a couple key items to be aware of. There was originally an 8-week measurement period that got extended to 24 weeks. So that's the time to spend those dollars on the qualifying expenses. So broadly, payroll, rent, mortgage, interest, utilities, those type of things. And then you have 10 more months from the end of your measurement period to do the application for forgiveness. So those are the key timeline points to keep in mind. Broadly, forgiveness is based on using the loan funds for those qualifying expenses and maintaining employment and maintaining people's pay levels. That's the big picture. For people with big loans, this can be, the application process and the forgiveness can be fairly complicated. So, we'd suggest the AICPA and other sources have put out templates that you can use, and you may want to go to a professional advisor as well to help you kind of navigate that process. I think that all those things I just said may fall in the category of stuff you already knew, but there are a couple tricky items that we're facing right now with the PPP loans. One of them, I already got a question posted before we even got started this morning, so thank you. So the big question is the tax issue, right? So you have your loan forgiven under this program. What does that mean for your tax reporting? And the CARES Act was really clear in its wording that loan forgiveness under this program is not taxable income. But then the IRS came along and they said, okay, sure, the loan forgiveness isn't taxable income, but the expenses that you paid with that forgiven money are not going to be deductible. And the IRS is making this argument really based on two kind of long-standing tax principles. One being that expenses allocated to non-taxable income are then not tax deductible. So that's kind of argument one. And then the other argument or backup argument is that expenses that you pay that you expect to have reimbursed to you are not deductible. So clearly this is less beneficial than we thought when we first read the CARES Act. And honestly, if I put my tax geek hat on, I think that the IRS argument does have some merit. But then if I switch over and put my client advocate hat on, I have to ask, what did Congress intend? Did Congress intend to be very generous with this? Did they intend for us to have our cake and eat it too? And, several members of Congress are saying, yes, they did intend to be very generous. The other piece that goes along with this, if we are losing deductions, well, what about the timing? So you spent the money on those qualifying expenditures in 2020. What if you don't have your forgiveness decision until 2021? And frankly, that's the position that I think many, if not most, of our clients are in. So this is, again, there are arguments on both sides of this. Really, you could justify going either way, but where are we right now? One is, I think that with another relief bill, this deductibility issue is pretty likely to be addressed. There's bipartisan support for fixing the deductibility issue. That said, we haven't come to agreement yet on a relief bill. So that could happen in lame duck. It could happen early next year. I suppose it's possible that it doesn't happen at all. So in the absence of that, what do we do right now? Definitely, if you feel like you have a really good chance of having the loan forgiven, the more conservative position right now would be to assume those deductions are lost for 2020. So for purposes of your estimated tax payments now, you might not take those deductions. That's the safer approach. I have heard rumors that we're going to get more guidance on that very soon. So hopefully we don't have to wait too long. And then two, if you're typically an early filer, we would just recommend that you do extend to just give a little more time for us to have clear guidance on this issue. Stacey, you can go on to the next one. So, if that's a lot of uncertainty. In case that's not enough, there's this one other issue. So since early on, borrowers that had the bigger loans, and they've really benchmarked that at $2 million and higher, they've always really been subject to a higher bar to prove that they needed the loan. But the guidance was minimal, the guidance was very vague. And so conveniently, a couple weeks ago, the SBA actually put out a couple questionnaires that are getting at the loan necessity question. And they're asking two sets of questions, and those are around one, how did the pandemic impact your business? And then two, what did your liquidity look like at the time that you made the application? And so, if the SBA determines that you haven't proved to their standard that you needed the loan, then they may seek repayment on the loan. And, the question right now is how strict are they going to interpret this? And I have heard opinions that really range from, if you had a good year, then you're not going to be able to prove you needed it, to, on the other end, the SBA is really just going after bad actors and fraud, and that they're not going to be that strict on a bona fide business that kept people employed this year. So, we'll see where that falls out, and I don't know the answer. I think one clear recommendation that everybody can take away is to have documentation in your files that show where you were back in early April or in May when you made the application. What was shut down, what was the uncertainty you were facing. So you really want to be able to support the position that you were in at the time that you asked for the money. So that is a fun one, and lots of questions still to come, and we'll be watching and try to keep you all updated. So with that, I'm going to hand off to Blaine, and he'll talk about some year-end planning strategies.
Thanks, Anna. So want to caveat first, we sent out a tax year-end tax letter kind of to all of our clients, which if you didn't receive one, we can get you one for sure. And what I'm going to kind of cover here, highlight some of the big ticket items in that letter, but for sure that letter will provide kind of more detail on each of these items. But basically, kind of have two tranches here of year-end planning strategies, one for individuals, one for businesses, and kind of what you can do in these last 2 months to help your tax liability go down. The first, which was briefly mentioned earlier on the charitable contributions slide and the changes of the CARES Act, was this idea of bunching your charitable contributions. So if you know or you annually give to your church or a foundation that you support or is meaningful to you, if you can kind of accelerate 2021's contribution into 2020 and make that bigger, that would be beneficial, especially in a year where we have the 100% limit and none of those contributions would be subject to carry forward on the 60% limit. So that's one idea. Similarly, is kind of with your medical expenses. So people who itemize their deductions, there's a 7.5% AGI limitation on medical expenses you can deduct. So if you already have medical expenses in 2020 and there's some elective non-emergency procedures you'd like to get done, it may be worth moving those up into November, December in order to increase your total medical expenses and get a bigger bang for your buck on your Schedule A, since there's that 7.5% AGI limitation. Do want to put out two kind of quick reminders. Any funds used for these expenses from an HSA or an FSA are not eligible as a deduction, as those are kind of already pre-tax dollars. So you can't get a tax deduction for contributing those funds to those special accounts and then also spending them on the medical expenses. Also, kind of a definitional thing on what qualifies as a medical expense. It would need to be for the diagnosis, cure, treatment, or prevention of a disease or a treatment affecting any structure or function of the body. So it's not really brain surgery. I mean, kind of things that are needed medical expenses would count, but not just wellness items wouldn't, like gym memberships or things or dietary things like that. So just kind of wanted to put in those two kind of caveats when thinking of medical expenses. Also, for those taxpayers out there that have kids in college, there's a couple different higher credits and tuition deductions. Unfortunately, they do get phased out relatively quickly based on income, but should you not be in that phase out and your kid is going to a school that has less than kind of $4,000 of qualified higher education expenses, as that is usually the benchmark for the credits, think about maybe prepaying the next semester's tuition, the spring semester, and moving those qualified education expenses into 2020 to maybe expand your credit opportunities. You'll see next is this idea of kind of family income splitting, and so the big issue here is you really got to trust your kids. So the strategy behind this is you would gift certain income producing assets, most likely stocks or investments in a brokerage account. You would gift those to your child who theoretically is in a lower income tax bracket, unless they're some type of TikTok or YouTube star, which they're probably in a higher tax bracket. But so what you would do there is now, instead of that interest or dividend or capital gains being on your return at a high bracket, is now at your child's return at a lower bracket. There's two kind of catches with, like everything else, there's a couple catches with this. One, back to the trust issue, when you gift those assets, those are now legally your child, so you would no longer have legal control over those. And two, they can't put off too much income, because if the unearned income is over $2,200 and your child is under the age of 19 or 24 if they're in college, then the kiddie tax gets kicked in, which essentially throws that income back into the parent's tax bracket. So it might not be a lot of dollars, but if you whatever you can remove from your return to a child's return is some type of benefit, or if you had a lot of children and spreading that over all of them, that would be a benefit. And then lastly, on the individual piece is this strategy of capital loss harvesting, which is kind of self-explanatory, but essentially if you had a stock that is down, you have an unrealized gain position on it, you don't think it's going to bounce back, go ahead and sell that before the end of the year and get that loss on your tax return. A quick reminder, net capital losses are limited to $3,000 a year. Anything above that would carry forward to the next year, so it's not lost, but you can only take a net loss of $3,000. So an even better situation is, say you bought some Amazon stock a few years ago and you're selling it now, big gain, and you have this maybe oil and gas or tech stock sitting there that's down. probably not going to come back in the near term. Go ahead and sell that stock, get the loss there to offset the Amazon stock, and essentially pay no tax on that Amazon stock gain. So that's kind of the idea of capital loss harvesting. And if your investments are with a brokerage house, they're very well versed in this idea, and probably might be even doing it before without even you knowing it. On the business side, just a couple highlights like we talked about. Any expense you can move into 2020 is good. So any property or equipment that your business would need maybe in 2021, it might be smart to buy it in 2020 and take advantage of the 100% expensing, the bonus depreciation. The catch with that is you do need physical possession of the property in this year, and you would need to place it into service, which means kind of using it in the business. So anything you can think of that you were going to buy maybe in January or February of 2021, if you can accelerate that into December, the more beneficial for your tax liability. As mentioned before, there's a kind of a number of payroll tax credits and payroll tax deferrals that are available to you. Again, we're going to point you to your payroll tax provider on those for the details and specific guidance, but did want to make you aware that there is programs out there that can help you from a cash flow perspective in deferring payroll tax on your employees. Now that we're kind of 2 years into the TCJA, most of you are probably familiar with the qualified business income deduction, so we're not going to go too deep into that, but we would recommend to just kind of give that an analysis or estimate it kind of in the next few weeks to see what your QBI deduction would look like, and then also if you're running up into the wage limit. So your QBI is limited to 50% of wages paid out. So if you're near that limit or you're under it, it might be worth considering instituting some type of year-end bonus program for you and your employees, which would subsequently increase your QBI deduction threshold. So just take a peek at that. And then finally, as Albert mentioned in the NOLs and the ability to now carry those back, just kind of anything you can move into this year, especially if you're already in an NOL position. Don't want to necessarily recommend going into an NOL, but if you're there and you can accelerate more expenses, whether through depreciation or wages or any other kind of typical operating expenses, if you can push those into 2020 and expand the NOL, then you could possibly carry back to a prior year where you were in a higher income tax bracket. That is also kind of a strategy that we would recommend at this time of year end. So again, those are kind of a highlights. Our year-end tax letter kind of outlines those in more detail and has a few others. So if you would like a copy of those, just let us know and we can get you one. So with that, I will turn it back over to Anna.
Blaine's actually, I'll go ahead and talk about kind of the future post-election tax law changes. So, before we discuss any kind of potential future tax law changes, right, many factors were determined if and when any other future tax proposals will be raised and passed. So for discussion purposes, as of today, the election is still not certified, and there are some states that will perform recounts. My understanding is that the states will have until December the 8th to count all the ballots or to count all the votes. The electors will then meet on December the 14th and actually cast the ballots. And then in early January, the new Congress will count the electoral votes and a president will officially get elected. So who ultimately wins the election will, of course, affect tax policy going forward. But other things to consider, what will the state of the economy and COVID-19 be in 2021? Would the Biden or Trump administration and Congress view additional COVID-19 response legislation or economic stimulus legislation as necessary next year? We got to think about future congressional elections. So, currently the Senate is 50 Republicans and 48 Democrats with 2 races, both in Georgia, that will have runoffs in January. So we won't know who will control the Senate until January the 5th. So for discussion purposes, let's say that Republicans win at least one of the runoffs. This will mean a divided government with the Republicans in control of the Senate and the Democrats in control of the House. So regardless of who is president, reaching bipartisan consensus on major tax policy changes in the next 2 years might be quite difficult in a divided government. We also need to think about the elections in the 2022 Senate elections, especially in the swing states of Wisconsin, Ohio, Pennsylvania, North Carolina. Could the winner of these elections make it easier or more difficult to pass major tax policies? Again, another unknown, but something to think about going forward. We also need to think about global tax developments. How might foreign countries change their tax regimes? For example, if a foreign country raised corporate rates as a result of the economic fallout of COVID-19, might this make it easier for Congress to support an increase in U.S. corporate tax rates? On the other hand, if the trend of lower corporate rates from the foreign countries continue, might that make corporate rate increases here in the U.S. Less politically attractive? So again, just a lot of factors to consider for future tax law changes. So on the next slide, to kind of keep things even keel, we wanted to provide some high-level tax proposals for both campaigns. So Vice President Biden has not released an official tax plan that includes all of his federal tax proposals. However, his campaign has posted a few items on his website, which include, at least for business purposes, raising the top corporate income tax rate from 21% to 28%. It could be creating a new 15% corporate minimum tax on global book income of 100 million or more. It also could be imposing a 10% surtax on corporations with offshore production that sell back to the U.S. Maybe some of Biden's individual tax proposals include increasing the top individual rates to 39.6 for incomes over a certain threshold, which happen to be 400,000. It could be eliminating the deduction cap for state and local taxes for 2020 and 2021. And it also could be taxing capital gains and qualified dividends for individuals with over 1 million in income at ordinary tax rates. So on the next slide, again, just to kind of keep things even keel, just want to provide some overall maybe proposals for President Trump. If President Trump somehow receives the 270 electoral votes through either legal battles or recount, here are at least a few kind of potential tax law changes. One thing to know is that President Trump has not released a formal plan describing his federal proposals for a second term. However, many people, it will be status quo of the current law. So for example, for the business tax proposals, we can see President Trump keeping the corporate rate at 21%, even maybe reducing it to 20%. There's been talks about maybe eliminating the schedule reductions related to bonus depreciation and the international provisions, as well as maybe creating tax credits that encourage companies to bring back jobs to the U.S. Same thing on the individual tax proposals, even though, like I said, it's probably going to be status quo, but we could see even, a decrease in capital gains taxes, maybe even enacting a capital gains tax holiday for yet to be identified period. But I think a lot of people believe that will be some kind of maintaining the TCJA's individual tax rates that are set to expire in 2025. So again, just want to give you guys kind of a high level tax proposals for both campaigns. Again, regardless of who is president, there are several factors that we mentioned that will determine if any major tax policies will occur in the next 4 years. So I think right now we actually have a polling question. So Stacey, if you can bring that up. So it's basically, what topic is of greatest interest to you today? So we have the latest guidance on PPP loans, which Anna talked about. We talked about the potential post-election tax law changes, the CARES Act changes and how they impact my business. Blaine touched on the year-end tax policy strategies. Or the last answer, will these tax nerds be spouting a bunch of IRS or IRC codes? And I know I'm already guilty of that. So we give you guys a few seconds, and then I believe Anna is going to talk about other tax-related items.
Yeah. Thanks, Albert. I think the whole issue of post-election tax policy is a really sticky one right now, and none of us have a crystal ball. So thank you for covering that in what I hope is a fair and balanced way. Looks like PPP loans are the hot topic, but at least a few people are concerned about whether we'll talk about too many code sections. So we'll try not to do too much. Stacy, you want to go ahead and hop to the next slide? So, you know, I think we've covered, I would say, the big headline items that, you know, you're seeing in the news that everyone's talking about. But there are a lot of other tax-related items that aren't top of the news and didn't make the list for a deep dive today, but they are really relevant for many of our clients. So I wanted to spend a little bit of time going through those. So first one I'll touch on, and Stacy, you can move to the next slide. Just before the CARES Act, there was the Family First Coronavirus Response Act, and we'll call that FFCRA. And included in that were some new mandatory paid leave provisions. Generally, this applied to companies with under 500 employees, and it added new paid sick leave and expanded FMLA. So the effective date for that was April 1st through the end of the year currently. I would say this is definitely something that would be on the table for extension if we get another COVID relief package. But, you know, as of now, scheduled to expire soon. And then the other piece to that is that the law included credits. So basically, the federal government is going to foot the bill for the extra leave that you had to pay under these mandates. And so right now, you know, again, this is not brand new news. The thing to be looking at right now is just to work with your payroll team and make sure that all the paid leave that you have paid under this mandate, that you've captured it on your payroll forms, because you do want to get all the credit that you are entitled to. We'll switch gears a little bit. State Nexus expansion certainly is not new for 2020. And I know that some of my long-term clients who may be listening probably think, here she goes again. I have heard this before, and I agree. But it's really important, and it's not always top of mind, especially for businesses and taxpayers that are in Texas, where we just don't have the standard income tax model here. So when we say state nexus, you know, what we essentially mean is you have enough contact, presence, engagement in a state for them to impose their income tax on your business. And kind of the old school way of thinking about this was more around your physical presence. So where do you have people? Where do you have assets? At this point, nearly all states have some sort of an economic standard, economic nexus standard for this. So that old way of thinking is pretty obsolete. We'll say the location, the location where you have your employees is still really important, but now we're really taking a look at where are you generating your revenue. You know, I'm sure you've all heard of the Wayfair case. That was back in 2018. And that was a sales tax case, of course, not income tax. And after that, now virtually every state has a nexus, you know, a factor-based threshold that says when you have to start collecting sales tax in their state. But similarly, states are increasingly adding a factor-based test for income tax too. So for example, they may say after you've had 500,000 of sales to customers in our state, you're now subject to our income tax or a franchise tax. You know, now luckily, if you have nexus in a state, it doesn't mean that you're paying their state income tax on your whole net income. We use apportionment, and that's, you know, effectively trying to calculate what portion of your overall income you're earning in that state, and then you apply the state rate to that. So really the most critical component of apportionment is the revenue sourcing. So and increasingly states are moving to market-based sourcing, and what this ultimately comes down to is where are your customers benefiting from what you're selling? That's, you know, has become the key question. So, Stacey, you can move forward one, please. Okay, so that's a lot of tax law talk, but why should you care? Well, states are becoming more aggressive in their enforcement efforts, and these are things that can kind of creep up on you, especially if it's a state you've never set foot in. I think, you know, you just wouldn't expect that they're going to come after you necessarily for income tax. And as states get hungrier for revenue, if we're in tough economic times, you know, they may start coming after you more. And also, if you have a future sale transaction, something like that on the horizon, just know this always comes up on due diligence every single time. So, so what can you do to manage this? I would say every year, take a look at your revenue sources. You know, where do you have people? Where do you have customers? You know, if you're a tax client of our firm, we are sending you an info request every year that says where are your people, where are your assets, where's your revenue. Those are a pain. I know they are a pain, but they really are worth it because it's a really good tool that helps us identify where you have some exposure. And then, once you're aware of the exposure, it's still a business decision, right? You can look at what's the risk, what's the cost of compliance, frankly, kind of what's the risk tolerance of our management or our owners, and you can make those decisions. But it's good to make informed decisions on that. So I will get off my state nexus soapbox, but it's something we'd love to talk to you guys about more. Okay. The next item, I fear, sort of veers into the territory of too much dense code section talk, so I will try to minimize that. 1061 is pretty technical. I think it's worth at least touching on because it does impact a number of our clients. So this was part of the TCJA, so passed back in 2017. And it's the so-called carried interest fix. Right, so these rules are meant to go after the fund managers who earn most of their income from profit distributions from sales of capital gain assets. And those are then subject to that preferred rate, maximum of 20%. So, the story or the argument is the hedge fund manager shouldn't be paying lower tax rate on their income compared to what you and I are paying. I think in making that statement, I'm assuming I don't have a lot of hedge fund managers on the call, and apologies if I do have some. So I'm going to really paraphrase and simplify, but what this rule says is that if you receive a partnership interest for performing services for a partnership that is engaged in raising and returning capital, investing, developing, disposing of certain assets, so these are your capital gain type assets, real estate, then you're going to be subject to these rules. And the rule says that in order to get that lower beneficial tax rate for your long-term gain on your profits interest, the hold period is expanded to 3 years versus 1 year. So we really went through 2 partnership filing seasons with these rules and just bare bones. We had the code section, we didn't have other guidance. And then we got proposed regs out in July that added some clarification to this. And, don't mean to belabor it too much. I think a couple points that are, relevant to make here. One is, 1231 gains. We were working under the assumption that they didn't fall under these rules. And that's really important because all the real estate developers, this is important to them. So you build a building, you rent it out for a year, you sell it, you have a big gain because the Austin market's doing great. That's 1231 gain. And we had understood it was not subject to the rule, and the proposed regs have clarified that. The other piece that was tricky to think about is, what does the 3 years apply to? So does it apply to the asset? Does it apply to your partnership interests? Really wasn't clear. The proposed regs have said you look at the hold period of the thing sold. So you sell the building, how long did the partnership hold the building? You sell your partnership interest, how long did you hold that? And there's more to it, but they did provide some helpful clarification. So again, I think probably time to stop on this one. Don't want to belabor it too much, but if this is something that is relevant to your business or to your partnership group, it is something that we'd be happy to talk to you about more. And then one final area I want to talk about is really fun, IRS reporting and compliance issues. So many of our clients have their businesses structured as tax partnerships or a great number of tax partnerships. And the IRS really is ramping up their focus on partnership tax compliance. One piece of this is the centralized partnership audit rules, I like to call it CPAR for short. This came into law a few years ago and became first effective with the 2018 tax year. And there are a lot of components to it, but the main idea is that the IRS wants to be able to audit the partnership and collect on underpayments from the partnership and not have to chase down all the individual partners, which was historically very difficult for them. So there are opportunities to elect out of this regime or to push out the liability to the partners. All of those involve extra reporting to help the IRS sort of track down those taxes that they're trying to collect. One thing that has come into focus, I would say quite recently for our group, is that under this new regime, partnerships that are subject to it cannot file amended returns anymore. So you can't, make a change for a 2018 issue, give partners a K-1 and change their 2018 tax liability. Going forward, we have this new, I would say, quite a bit more burdensome administrative adjustment request process. So you can still change the reporting for 2018, but those changes filter through to the partners in the year that you file the AAR. So that's just really a kind of a mind shift compared to the way we operated for quite a while, and something to be aware of. So what to do about this? I would say, one, strongly consider electing out of this regime if you are able to. In order to elect out, a partnership has to have 100 or fewer partners. They can only be individuals, corporations, S-corps, and estates. So in practice, I would say many, probably the majority of our partnership clients are not eligible to elect out. But if you can, definitely something to consider. And then for all partnerships, we strongly recommend that you extend that tax return. So even if you file by March 1st, that's great, but file an extension for the March 15th deadline. So then you have all the way till the September 15th extended deadline in case something comes up. We certainly, we intend and hope to always get it right the first time, but sometimes new information comes up. If you file an extension, you can make a change all the way through September 15th using a superseding return, which is pretty easy and we're still allowed to do. So those are my two recommendations there. Another piece of the IRS compliance push on partnerships is just every year they're adding more complexity to the K-1 reporting. So they're really just trying to create a roadmap for themselves to find potential issues with the partnership and its partners. So the big new thing for 2020 is that they're requiring tax basis capital accounts on the K-1s. So some partnerships have always been doing this. Many have not. If you have not, this will look a little bit different this year. So just letting you know. And it will require some extra time for your tax preparers, maybe a little, maybe a lot, as that's going to kind of depend on what your underlying records had in them beforehand. And then just one last note, we had, the IRS is having a rough go of it this year, just like a lot of workplaces are. I was in a tax conference last week, virtual of course, and the IRS commissioner talked to us and he said that as of July, they had 24 million pieces of unopened mail. So they are working through it, but it's been tough. And so we've heard a lot of clients getting notices, say tax due on things that they already paid. Just processing has been really slow. And not a lot of practical recommendations I can make there. I'd say try to have some extra patience. If you're concerned, please pick up the phone, call us. We can try to help or at least try to ease your mind. And then maximize electronic filing, maximize electronic payment in lieu of paper and sending checks wherever possible. So that's kind of what we had for our plan discussion. I'm realizing I did a really bad job of ending on a high note because this is kind of a low note, but we would love to answer questions. It looks like we've got plenty of time, so we will hop over and check out the question section and answer any of those. So thanks, guys. Okay, so we have a question. I will take it from Z, who I think I know from way back when. Hi, Z. She said, now that we're in a work from anywhere environment, so employees may be working from various states, what payroll issues are you anticipating due to employees working from various states? I will say I am not a payroll expert. I do think that generally the payroll needs to follow where your tax home is in terms of sort of state income tax withholdings. But I do know that several states have come out with rules kind of providing a carve out for these COVID times. So let's say, if you always worked in Texas, say, but you had to go and be with your parents in Oklahoma, and then there was lockdown and you ended up being stuck there for the remainder of the year, a lot of states are going to give an exemption and say, yes, having a person in that state typically would create nexus, but we're going to give you a little break because they're only there because of COVID. They normally would work in Texas, and so you may get a pass. If people are making permanent moves, so that's the other thing that's come up is people say, hey, I can work from home. I don't need to live in Manhattan anymore. I'm getting out of here. And they make a permanent move to a new state. Then, your payroll tax filing, your nexus, that is going to track because that's now a permanent thing. So if your employee now lives in Connecticut and they're going to be there forever working for you, then you probably will have nexus in Connecticut for income tax as well. Let's see, are refunds being delayed? I would say yes. I don't know that they all are. Electronic filing and using your direct debit and deposit definitely helps with that. But I have also heard certainly that refunds are being delayed, especially on things like the loss carryback issues. Those tend to be a little trickier for them to process, and so those are taking longer, I would say. And I don't, if Blaine or Albert, feel free to hop in on any of these if you would like to. I don't claim to be expert on individual taxes. Let's see, can we request a recording of this webinar? I believe yes, but maybe Stacy will confirm that for me. But yes, I do think that we'll have this recorded and you can take a look at it later.
And then Anna, there is a question that's appearing in the chat box.
Yeah, I see that now.
PPP.
Yeah, thank you. So we got a PPP loan and in an estimated tax calc deducted the expenses and now qualified for PPP forgiveness. We're waiting on the bank to allow us to file. What should we do now? Additional estimated now shortage, pro or con of forgiveness in 2021. I wish that I had the certain answer on this. Like I said earlier, I think if you are able to cover your estimates under the assumption that you're going to lose those deductions in 2020, that's safer. We have some more time until we file returns. We can extend, but if you can't, if that's really a hardship to cover your estimated tax payments using that assumption, then we understand that too. And, again, don't have a perfect answer. I think that if you do receive forgiveness, it's fully forgiven before, kind of clock ticks over to 2021, if they don't end up being deductible, you're going to have a hard argument for pushing that tax hit to 2021. So I don't know if you have any leeway on that. If you don't have the forgiveness until next year, then you're going to likely be in the area where there's some wiggle room in terms of the timing. Again, that's going to be pending the guidance that comes out. Looks like we're getting more questions in the chat. So, okay, next question. Can you recap guidance on PPP loans less than $2 million and whether to accelerate the application process now rather than waiting? So, I guess the application process, if you're under 2 million, is going to be quite similar. There are some very simplified applications for if you had a very smaller loan amount or if you're self-employed. But if you had, say, $1.5 million, you're going to still go through the application process. What we don't expect is that you will automatically get that questionnaire I mentioned. So the questionnaire that asks those really hard questions on, did you really need this? I don't expect that you're going to you probably won't get that from your banker. So I think, again, that $2 million bar was really making it harder for people to prove that they needed it. Other than that, I think the process will be very similar. And on accelerating it, my feeling is not to rush, just because, like I've said, there are so many unanswered questions and you do have that whole 10-month window from when your 24 weeks ended. So that's my feeling. Other people want to really be sure and get that forgiveness nailed down right away. You can do it sooner. Again, like I said, if you get the forgiveness in 2020, then you're kind of not as much in the gray area, and I think you'd probably just have to take the position that you can't deduct the expenses related to it unless a relief bill changes the rules on that. Okay. Clarification maybe for corporate 1120 filings or refunds being delayed. I'm wondering if my friend Albert has any input on that.
I would say just probably overall in general, I think the IRS is struggling to kind of keep up. So, 1040s, 1120s, 1065s, I think they're all kind of in the same bucket. So I think, like I said, IRS is struggling. There might be delays in all kinds of refunds. So we just advise people to kind of stay patient.
Let's see, I think we're still good on time. So I see another question. If all employees are working from home, is mileage for local trips to the post office, other employees' homes for business reasons, etc., a deductible business expense for the employer and a reimbursement to the employee? So I'm going to say, I haven't thought this through. I don't know for sure. My belief is that, you know, typically in the normal world, you commute to the office and home. That's not business travel. If you go to the office and then you have to go see 3 clients and go to the post office and all those extra trips, that typically is business mileage where the company could reimburse you and take the expense. I think what you've mentioned falls in those lines. So if your home office is your office, then the extra business trips you're taking during the day that are not commuting, I would think that those become reimbursable business miles. Let's see. Do you guys, I don't see any others. Oh, thank you. I don't see any others in there right now, so we may give it 30 more seconds in case anyone else has anything. But again, thank you for your time. Sorry that we couldn't see you in person. Hopefully next year we will be doing that. We have our contact information up here on the screen. We would love to hear from you. Give us a call, shoot us an email. If we're not the right person for it, we'll find somebody on our team who can help you out. Oh, and it looks like one more came up. So can you please repeat what you said about the CARES Act and the payroll credit? Is that in addition to loan forgiveness? And yes, I know you said to reach out to payroll provider. There are a lot of moving pieces in this. So it's hard to know how they apply and can we do this one plus this one. And so, you know, the CARES Act had the PPP loan. We talked about that quite a bit. What cannot overlap is the employee retention credit, which Blaine touched on briefly. He didn't go way into. That was another avenue for businesses that really have taken a big hit in 2020 to get credit for, you know, if they kept their people on the payroll to get credit. So those two don't overlap. The CARES Act also gave a payroll tax deferral option, which said from, I believe, April 1st through the end of 2020, you can hold off on sending the cash for your employer side Social Security tax. You can kind of hang on to that cash, send half of it at the end of 2021, half at the end of 2022. So that's a pretty long window. Those can be used in conjunction with the PPP program. You can't ever be double counting the same dollars. And so and just anecdotally talking to some clients in the past couple months, a lot of people have not been doing that CARES payroll deferral, but I have heard that some are. And I would just caution, you know, keep track of that cash, right? Because it can add up and that's a long window and you don't want to come to the end of next year and, oh my goodness, we have to send in $100,000 and we didn't plan for it. So it can be helpful to kind of hope you maintain cash reserves, but just, I would say, be careful with that one. Let's see. Would you recommend putting PPP related expenses in an asset account pending forgiveness of the loan in 2021, which is the liability in 2020, and then the payoff moves to PPP revenue in 2021 to offset the to offset the move from the asset to expense also in 2021. I hope I'm following that. I think you will, you know, if you got cash and you have a loan payable and you get forgiveness in 2021, I think that is, you know, I think on the GAAP side, you know, that's where the loan would write off and it's going to become kind of an income item then. We'll have some book to tax differences in the reporting for this, and sort of, as I mentioned, how it plays out for tax is still a little bit up in the air. I will say, I'm not sure I totally followed or answered that correctly, so if you feel free to ping me or email me after and we can kind of sort that out. Anything else? I'm not seeing any other ones. So again, thank you for your time. Please get in touch with us. You know, we'd love to talk to you, and hope everybody has a good rest of your day. Thanks, guys.